Did you know that the profit from selling your house is subject to additional taxes? It's called capital gains taxes, and it's applicable to every seller, whether it's your primary residence or an income property. Capital gains can equate to thousands of dollars. So today I want to discuss strategies on how to completely avoid, defer, or at the very least, reduce your tax liability. Let's get started. Hey everyone, welcome back to my channel. I'm Erica Monroe. I'm a realtor in the Bay Area and I specialize in Solano County. Disclaimer, I am not a tax accountant. Calculating capital gains can be really complex and your file may be unique, so make sure you check in with a tax accountant or a tax professional to ensure you really understand your specific scenario. Rule of thumb for any property, regardless of whether it's a primary residence or an income property, is that you want to hold the property, you want to own the property for at least 12 months. If you own it for less than 12 months, the government is going to tax you at a short-term capital gains rate, which basically means they're going to treat any profit that you make as standard income. Dependent on your tax bracket, you could be taxed up to 37%. So definitely important, if at all possible, to retain that property for at least 12 months. Now moving on to primary residence. For a primary residence, you want to own a property for at least 2 years. And if you do so, you may qualify for a homeowner's exemption. For a single person, that's $250,000 that you get to deduct from your taxable profit. And if you're a married couple, it's up to $500,000 that you get to deduct from your taxable profit. Let's look at an example to make it a little more clear. So let's say you purchased a house at $500,000 2.5 years ago. And because of the aggressive appreciation that's happened, you can now sell your home for $800,000. Just for ease of this example, your taxable profit would be $300,000. As a single person, you would be able to apply $250,000 towards that taxable profit. So your new taxable profit would be $50,000. If you are a married couple, because your exemption is up to $500,000, you would have no capital gains to pay. So again, very important to retain that property and live in the property for at least 2 years in order to be eligible for this exemption. Otherwise, the total profit amount will be subject to taxes, which is going to be either 15% or 20%, depending on your tax bracket. Stay tuned to the end when I discuss several strategies on how to further reduce your tax liability and your tax bill. For income properties, again, you want to retain that asset for longer than 12 months. And unfortunately, either way, there is no homeowner's exemption. However, there is a way to defer your capital gains tax payments basically indefinitely. This is through a 1031 exchange or a like-kind exchange. Essentially, a 1031 exchange allows you to use the proceeds from selling your income property to purchase another income property, and then your taxes are deferred. As long as you continue that pattern, so you sell your income property to purchase the next income property, you basically do not pay capital gains until eventually you sell that asset. 1031 exchange has a short time frame for you to identify a property that you're interested in purchasing. If you again don't abide by those timelines, then you are subject to paying regular capital gains taxes. So how do we further reduce your tax liability or your tax bill? Well, if you've owned a property for a decent amount of time, you've probably put money back into the house towards capital improvements. Improvements that increase the value of the home, that increase the longevity and functionality of a space. So replacing windows, adding wall-to-wall carpet. If you've done a kitchen remodel, as long as you have those receipts available as proof, you can add that towards your tax basis and subtract that from your taxable profit. So let's take that same example from before. You have a $500,000 home that you purchased 2.5 years ago, right? We're selling it for $800,000. Our taxable profit would have been $300,000. Well, if you spent $50,000 remodeling your kitchen and you have the receipts, you can add that $50,000 to the original purchase price, which is your cost basis. the cost of the home plus any improvement. So now we start with a $550,000 cost basis. We sell it for $800,000. Our taxable profit would then be $250,000. And again, for primary residence, that would eliminate any need to pay capital gains, whether you're a single person or a married couple. You can also subtract a lot of your closing costs from your taxable profit. It costs you money to sell a house, right? You have to pay agent commissions. You may hire a stager, which is considered advertising and an item that you can subtract from your taxable profit. It's not profit that you actually got to keep. It's money you had to spend in order to sell your home. That can equate to thousands of dollars. So it's important to keep your receipts for things like staging, potentially landscaping. All of that gets subtracted from your taxable profit, leaving a lot more money in your pocket and less money that you have to pay to the government. For more specific information on what fees you need to consider as a seller, check out my video on seller costs in Vallejo. Thanks so much for watching. Please like, comment, subscribe, ding that little bell so you're notified when I post my next video.